So, a healthcare giant just hit the public markets, and wow, its very first report is quite the story. We're talking about Medline, a company that's seeing this absolutely massive, incredible growth, but at the same time, it's facing a major financial squeeze. You gotta ask, how is that even possible? Well, let's get into it.
Okay, so what does this two-sided story actually look like? Well, on one hand, you have this explosive success, but on the other, there's a serious challenge that's putting a ton of pressure on their bottom line. And it really all comes down to the numbers.
So let's dive into the financial scorecard. This is where you can really see that story come to life. And it's basically a tale of two very different numbers. All right, first up, the good news, and it's really good news, their revenue. In just the last 3 months of the year, Medline pulled in a staggering $7.79 billion. I mean, that's just a massive number, and it tells you that the demand for what they're selling is just off the charts. And listen, this wasn't just a big number in a vacuum. It was a huge beat. Medline completely blew past what Wall Street was expecting by more than $268 million. That's the kind of thing that shows they've got some serious momentum. But, and this is a big but, here's the other side of that story. When you look at their actual profit, their earnings per share, it was -1 cent. Yeah, you heard that right. Despite bringing in almost $8 billion in sales, they actually lost money on a per-share basis. So just like their revenue was a huge beat, this was a huge miss. Wall Street was expecting them to make a profit of 24 cents a share. So this begs the question, right? How in the world do you sell billions of dollars worth of stuff and still not make a profit? Where is all that money going? And this isn't just a weird one-quarter thing. This table here shows the full year picture, and it tells the exact same story. Take a look at the top line. Net sales are up a really strong 11.5%. Even their core earnings, their EBITDA, is up a little bit. But then look at the bottom line. Their final net income actually dropped by 3.6%. So more sales are leading to less profit. Let's figure out why. All right, so before we get into the problems, let's look at what's going so right. I mean, what is the growth engine that's driving all that revenue? How are they growing this fast? Well, here's a huge piece of the puzzle. Last year alone, Medline signed a record-breaking $2.4 billion in new customer deals. This isn't just them growing with the market. This is them actively going out and winning business, taking market share from their competitors. And here's a perfect example of how they're pulling that off. The CEO, Jim Boyle, shared this story. There was a huge healthcare system that used to work with five different distributors. They dropped all of them and moved their entire business over to Medline. Why? Because Medline is successfully pitching themselves as the one-stop shop that can just handle everything. Okay, so we know sales are absolutely booming. But what about that profit squeeze? To get that, we need to talk about the really big obstacle that's standing in their way. The main problem, the big headwind they're facing, is tariffs. And just a quick refresher for everyone, a tariff is pretty simple. It's a tax on imported goods. And for a company like Medline, with this massive global supply chain, those taxes directly jack up the cost of pretty much everything they sell. And this chart really puts that problem into perspective. In 2025, tariffs cost Medline $290 million. But look at the forecast for next year. That number is expected to balloon to nearly $500 million. That is a $500 million hole in their profits that they somehow need to fill. So how in the world do you fight back against a $500 million problem? Well, this brings us to Medline's strategic playbook. Let's see what they're actually doing to try and build a more profitable, more resilient future. First things first, let's talk about their IPO. Medline raised a ton of cash, over $7 billion. So a huge part of their strategy is what they decided to do with all that money. Their first move was a really smart defensive one. They took a huge $4 billion chunk of that IPO money and right away used it to pay down their debt. And why do that? Well, it's simple. Less debt means less risk, and it gives you a lot more financial flexibility down the road. And you can see the impact of that move right here. Their net leverage, which is really just a fancy way of measuring a company's debt compared to its earnings, it dropped in a big way. It went from a pretty high 4.9 times down to a much healthier 3.1. This just makes them a much more stable company with more firepower to invest in their future. So paying down debt, that's a defensive play. The other part of their strategy is all about offense, a massive investment in technology and automation. I mean, it makes sense, right? If your costs, like tariffs, are going up, the only way you can really protect your profits is to make your whole operation more efficient. And they are going all in on this. On one front, they've got over 2,100 of these auto store robots in their warehouses, just picking and packing small items. Then for the bigger stuff, they're piloting this AI-powered robotic system called Symbotic. And then to tie it all together, they're building an AI control tower with Microsoft that can actually predict supply chain problems before they even happen. It is a massive tech overhaul. So let's bring it all together. What we have with Medline is a company with two powerful opposing forces at play. On one side, you've got this incredible market-dominating growth. On the other, you have this nearly $500 million cost problem that's just eating away at their profits. Now, they are making what look like really smart, long-term moves to fix their finances and boost their efficiency, but the big question remains, can their strategy outrun their costs? Can they actually turn all that amazing growth into the kind of profit Wall Street demands? For this new public company, that is truly the billion-dollar question.